Rate rises, inflation, the war in Ukraine and the end of COVID have created a unique set of financial challenges. But are banks, politicians, regulators, as well as you at home, ready for what happens next? The financial crash in 2008 shook the world.
It was the worst day on Wall Street since the crash of 1987.
Leaving almost 9 million US workers unemployed.
On the basis of employment, it's doing about as poorly as you can imagine.
But could the banking crisis of 2023 be bigger and deeper than the credit crunch? Well, here's a list of US bank failures since 2001. And this line shows lost assets, peaking at $374 billion per year in 2008. But take that line to 2023, and as we know, it rises to $548 billion. That's more than the entire financial crash put together. Now, let's compare the size of the total banking sector. Remember this phrase?
Too big to fail.
Too big to fail.
The fear was if banks went down, they'd take the entire financial sector with them. But does that mean today's banking sector has shrunk to keep the rest of us safe? Well, back in 2009, deposits held in banks were just under 85% of total US GDP. But by 2020, that number had risen to over 100%.
The only solution to the First Republic Bank collapse was to merge it into the JP Morgan Chase Bank. At that point, you really have to begin to laugh to avoid crying. Why? JP Morgan Chase is already the first or second largest bank in the United States. It is among those humongous banks that were declared back in 2008 and 9 as quote-unquote too big to fail. In other words, so large were these banks that were they to fail in the manner of other banks, they would take the whole system down with them.
Now, if you've watched all the films in our banking series, you might be thinking that banks and regulators have very, very short memories. Mistakes happen, and then the same mistakes happen all over again. But some lessons are still being learnt along the way. Part of the problem in 2008 was liquidity, or when banks couldn't get their hands on enough money to pay the bills. But today, they have more cash set aside, and they've been investing their depositors' money in safer things. During the financial crash, banks had just 13% of their money in government-backed securities, or set aside as cash. In 2022, that number had nearly tripled to 35%.
In the last 10 years, ever since Lehman Brothers went down, US banking regulators, have been forcing the banks to buy more and more US government bonds. Partly because they thought that, if they're sitting on all these safe bonds, they will never be able to make trouble ever again. So banks' holding of government bonds went from $1 trillion to over $4 trillion. Now, if you have the patience, you could just wait, and until basically the bonds mature, the banks would have been able to get their money back.
Another reason that people aren't panicking is that it hasn't hit us where we live, yet. You might remember from our last film on how to spot a banking crisis, how reliant banks are on people repaying their mortgages. In 2023, the housing sector still looked as safe as, houses. In 2008, banks lent money to uncreditworthy customers. The subprime mortgage scandal that followed led to over 2 million foreclosure filings. That number in 2022 was down to just over 320,000 houses being foreclosed. Less than it was when the economy was booming back in 2005. So does this mean we've got nothing to worry about?
In 2008 and 9, the precipitating catastrophe were the mortgage system. In other words, the vast number of Americans who could no longer make their monthly mortgage payments for the loans they had taken out to buy their homes. Whereas the crisis now isn't particularly focused on mortgages, it has more to do with corporate deposits and the misinvestment by bankers of those deposits.
But perhaps part of the reason that 2008 felt so scary was that regulators and politicians couldn't fix what they didn't understand.
In 2008, the crisis came about because of something that's very complex. These very, very complex credit instruments that had been developed in the universe of mortgage, basically loans. We're talking about the CDOs, double CDOs, whatever it is. And then only very, very sophisticated investors were involved in that market. Okay? It was a very opaque market, was a very illiquid market, and only the most sophisticated people were involved in that market.
Now, before we continue, a reminder that here at Capital.com, we make explainer videos about trading and economics, giving you insights on the markets so you can make informed trading decisions. We're also a trading platform, so you can make your trades right on our website or using our app. After this, check out our film on what happened in the 2023 banking crisis. Today, there are more than enough reasons for negativity. There's record-breaking inflation, interest rates are still rising, and the American government has decided to busy itself by shooting down UFOs.
There is no indication of aliens or extraterrestrial activity with these recent takedowns.
So here's another reason to be pessimistic about the banking sector.
Here in the United States, the mismanagement of the COVID-19 crisis is so severe that roughly 50% of the workers who used to go to an office every day are now working from home. One consequence of that is that office space, which was built up in the United States in the previous 25 years, is now half empty. And that means that half is not paying rent. All of those office buildings were built based on bank loans. Those loans cannot be repaid if only half of the offices are rented. Those banks are therefore sitting on loans which appear to be the value they were when they were issued, but they aren't because they can never be repaid.
Fear not. There are still reasons to be cheerful. The first 3 minutes and 59 seconds of the last SpaceX launch were amazing. And there's less chance of someone asking you if you understood everything everywhere all at once. So for the sake of balance, here's another reason for optimism.
Banking crisis usually it's about impairment of assets. In the case of the 3 banks that went down, there was no impairment in the sense that there was no asset quality issue. It's not like all of a sudden debtors decided that they can't pay what they don't want to pay and whatever it is. There was no issue of that kind.
We're going to leave you with a question. If we don't want to be talking about another financial crisis a decade from now, is it time to ask someone else to look after our money?
Banks ought to be run by elected, democratically chosen people. They should have on their boards workers who work in the bank and customers who use the services of the bank. Together, public representatives, customers, and workers can operate these banks. Having a large group in charge will make sure that the cozy relationships which keep exploding every few years are caught early on by workers or customers or public representatives whose job it is to make sure that the bank serves the social functions for which it is held accountable.
Thanks for watching. You can read all our original market analysis by visiting Capital.com. There's a link in the top right-hand corner and also in the description. And of course, don't forget to click on the subscribe button to stay alerted to more films on similar topics in the future.